Imagine this, you've made it. Your freelance gig is booming, your company's bank account is looking stacked, and your little brother comes knocking with a genius idea to change the world with geothermal energy. So, naturally, you want to help. You crack open the company vault, send him the cash, and bam, a surprise £20,250 tax bill slaps your company across the face. Welcome to the S455 tax trap, where good intentions meet brutal tax reality. Here's the setup. Tim, a Kiwi IT contractor crushing it in Manchester, has built up serious cash in his company, Prince Tui Tech Limited. Josh, his younger brother and geothermal whiz from Taupo, needs £60,000 to launch a clean energy startup in Cornwall. Sounds like a no-brainer, but the moment Tim tries to personally borrow that money from his company, tax law rolls in like a grumpy customs officer at Heathrow. And they are carrying Section 455. Section 455 in a nutshell. If you're a director and shareholder in your own company and you take a loan that isn't paid back in full within 9 months of your company's year end, HMRC charges the company 33.75% on the outstanding loan amount. So if Tim takes out £60,000, doesn't pay the total amount back on time, his company owes HMRC £20,250. Not eventually, not hypothetically, right now. And sure, it's refundable, eventually, but only 9 months after the accounting period in which it's repaid. If the loan lingers for years, so does that missing £20,000. That's not a slap on the wrist, that's a full-on rugby tackle to your company's cash flow. Wait, you say. Why not repay it just before the 9-month mark, then borrow it again? Nice try, but HMRC's seen that movie. It's called bed and breakfasting. If you repay the loan and then get another one within 30 days, or even plan to, they'll just treat it as if the first loan never left. That 33.75% tax? Still due. The only way out is a genuine, lasting repayment, not a quick shuffle to dodge the rules. HMRC wants the money back for real, not a temporary disappearing act. And it gets worse. Take more than £10,000 from your company without paying interest at HMRC's official rate, currently 3.75%, and now you've got a taxable benefit in kind. That's more personal tax for Tim, more national insurance for his company. Add it all up, you're now dealing with interest charges, income tax, NICs, and a frozen chunk of company cash. It's like trying to rescue your brother's business idea with a suitcase full of tax grenades. So, is there a smarter way? Yes, the company-to-company loan. Instead of lending to himself, Tim's company could lend directly to Josh's company. This skips the S455 and benefit-in-kind chaos. Clean business-to-business. Sounds beautiful, right? But HMRC isn't handing out high fives just yet. If your company loans money to a connected company, like one run by your brother, there are still a couple of things you need to be aware of. So what does connected mean? If you run one company and your brother runs another, HMRC sees them as connected, even if they're separate on paper. Family ties count. And for a company deemed connected, what's the risk? If the loan goes bad, your company gets no tax relief. That's £60,000? Gone. No deduction. No sympathy. Just HMRC's cold, hard rules. And if the loan looks too cozy, no interest, no repayment plan, no commercial logic, HMRC might roll out Section 464A, the anti-avoidance hammer. Because if it looks like you're using company money to quietly boost your brother, congratulations, you're back in HMRC's half, and Section 455 is in play. Bottom line, if you're thinking of funding your sibling's startup with company cash, do it smart. Avoid the personal loan route unless you're ready for a tax maze and cash flow headaches. Structure it as a proper business-to-business loan with commercial terms, interest, and a clear repayment plan. And for the love of spreadsheets, document everything. Contracts, board minutes, business plans. Paper trails are your best defense. Because in the world of tax, helping family without planning is just another name for voluntarily sponsoring HMRC. And yes, Tim, maybe next time just buy your brother a birthday card. Or at least run the plan past us at No Worries first. We're great at stopping brilliant family ideas from turning into brilliant tax disasters.